Tesla stock just surpassed its all-time highs, breaking through the $900 level and closing at almost $910 per share. In late January of this year was when we saw Tesla last hit the $900 mark, but at that time the company had just started building its new gigafactories in Berlin and Austin just a few months earlier. We had just found out that Tesla had delivered almost 500,000 cars for the full year of 2020. Tesla AI Day hadn't happened yet, with Tesla showcasing their technology for FSD. The beta program was in its infancy, and there was a looming chip shortage with uncertainty of what would happen in the future. So fast forward until now, and Elon Musk and the team at Tesla have worked extremely hard to deliver stellar results despite the backdrop. They've been able to navigate shortages and supply chain issues by taking quick action, adding new chip variants, and writing new firmware for these chips. While we've seen a large impact to almost all of Tesla's gas-powered competitors, Tesla has absolutely crushed it, and EVs use about 10 times more chips than ICE cars. Today, Tesla is rapidly making improvements with their full self-driving capability software and widening the size of the beta. We now know that the company is on track to deliver approximately 900,000 cars this year, which would be about 80% growth over last year's deliveries. This is incredible given Elon Musk's prediction of 50% plus growth per year. And most importantly, we've recently seen the inside of Tesla's new gigafactories, and Zachary Kirkhorn, Tesla's CFO, confirming that they're on track to bring these factories online this year and likely start delivering vehicles at the beginning of 2022. So Tesla actually appears to be in very good shape right now, with record earnings, revenues, and deliveries, exceeding their long-term operating margin forecast with 14.6% operating margins and over 30% margins in automotive, which is what analysts love to see. And yet, the stock is back to where it was in January. Now, Tesla stock could have been ahead of itself back then, and finally, now the company's growing into its market cap. But the next phase of Tesla's growth seems to be very positive, with many big things coming in the near future. Now, one of the things that was discussed on the conference call was that Tesla is planning to bring back Model S and Model X production back to their all-time highs and even beyond that based on demand, as stated by Zach Kirkhorn. To me, that's very exciting because these are Tesla's premium vehicles that basically put Tesla on the map. Of course, the Roadster was the company's first vehicle, but Model S and X were key to help Tesla get to where it is today. And not only is the company not giving up on these product lines, but they're doubling down on them, making the Plaid version some of the best cars in the world. And I think that will continue to give Tesla's vehicles a very positive aura and perception as they have the best cars on the market. For example, the Model S is a great car and sets the tone for the brand. So even someone who's seen the Model S, maybe test-driven it, but perhaps can't afford it, will still buy a Tesla for the brand and look at the Y and the 3. So although word of mouth is popular, I think even the premium brands help to create a very positive energy and brand around the company. Now, even though Tesla plans to take out its highs with Model S and X in terms of deliveries, which was about 100,000 vehicles, these Plaid cars are actually more expensive to purchase because of all the new technology and improvements that Tesla has put in, but they're reportedly cheaper for Tesla to produce as they've gotten much more efficient over time in terms of production. So from an earnings perspective, these vehicles will contribute enormously to margins and the company's profitability, and now that Plaid Model X deliveries to customers has begun, Tesla still has room to double and maybe triple what they did in the current quarter. They delivered just over 9,000 of these cars, but Zach Kirkhorn says that Tesla is looking to take out its highs, which would be about 25 to 27,000 vehicles per quarter. Now, during the quarter, one of the negatives, which may actually be a positive, is that Tesla made less money from regulatory credits. Now, of course, this means less free money for Tesla, which was coming from their competitors. It was $279 million, still over $1 billion for the year in terms of the run rate, but it looks like these credits are in decline. On the positive side, this has been one of the angles of attack of Tesla bears who were saying that all of the money that Tesla was making was coming from these emissions credits. But really, we're seeing that this was only temporary as Tesla swung from being unprofitable to a very profitable powerhouse of a company. And they were able to deliver record results even with falling regulatory credit revenue. Now, funny enough, Tesla took a $51 million loss on their Bitcoin investment in the quarter, which really makes no sense. It has to do with a dumb accounting rule where if the value of Bitcoin drops below what Tesla paid, they need to write down the value, even though they didn't actually sell or anything. So for one day in the quarter, Bitcoin did fall below Tesla's cost basis, resulting in that write-down. Even though in reality, Bitcoin recently blew through its all-time highs, which has technically made Tesla about $1.5 billion. If they decide to sell portions of that at these prices, they would recognize these large gains. But for now, Tesla is still hanging on and didn't make any trades during the quarter. Now, one of my favorite parts of Tesla's third quarter earnings report that actually made me laugh out loud was this chart here that shows Tesla's installed annual capacity. And the funny thing here is that they didn't really update this chart from the last quarter. And you might notice that for Giga Shanghai, it still says greater than 450,000 vehicles of capacity, which is in fact correct. It is greater than 450,000, but even Elon Musk has said at Tesla's annual shareholder meeting that Giga Shanghai has actually surpassed Fremont in production. In China, Tesla delivered about 56,000 cars in September and produced over 50,000 of them in just that 1 month. That implies a capacity closer to over 600,000 vehicles for the year, which does surpass Fremont's total production, which is also 600,000, including models S, 3, X, and Y. So China appears to be on fire, which I think will help Tesla grow deliveries next year above what many people expect. Even in the last quarter of this year, China will likely help Tesla achieve record deliveries yet again, even though Tesla is sandbagging on its capacity. Moreover, Cathie Wood, CEO and CIO of investment firm ARK Invest, has noticed in the past that even with the chip shortage at play, there have been some weird things that don't really add up. She's pointed out that used car sales have dropped, which is strange because used car sales don't need chips since they're already built. And because of that, perhaps there is excess inventory in the system which isn't showing up at the dealerships, but instead it's in people's driveways. Additionally, as previously mentioned, ICE cars seem to be having tons of trouble with chips, but EVs not so much, even though electric vehicles use considerably more chips. As a matter of fact, the EV market continues to grow rapidly, and one would think, as Cathie Wood says, that if ICE cars are not selling, that would free up chip capacity for EVs. They're also seeing that the ICE car industry appears to be getting more chips essentially than they're using. So the conclusion here is really that something else must be at play, and Cathie Wood attributes that to the shift to EVs, which she said at the Milken conference this week have been taking away massive market share from traditional gas-powered vehicles, and Tesla stock is finally responding to that. This was actually one of the stunning revelations from Tesla's earnings call, basically confirming what Cathie Wood has been saying through the lens of Tesla, where CFO Zachar Korn said that there appears to just be quite a profound awakening of the desirability for electric vehicles. And he says, to be totally frank, it's caught us a little bit off guard. He cites a change in consumer sentiment where folks want to buy an electric car and they want to buy a Tesla right now. He says this is very exciting for Tesla, but they need to put in extreme effort to build out more capacity for electric cars. So this is extremely bullish for the company. They're saying they have so much demand, even at these record levels, and even Tesla, which is further ahead than anyone else in EVs, didn't expect this. That's big news that Tesla is excited about, but also a large blow to any Tesla bears who've ever said that Tesla has no demand or will run out of demand. That doesn't appear to be the case, at least not anytime soon. Tesla is only satisfying about 1 to 2% of the overall car market in major countries worldwide, and everyone has suddenly decided that they want an electric car. So where do you think Tesla stock is headed after seeing the recent quarterly results and blowout delivery numbers? And let me know in the comments what you thought was the highlight or the most important thing that Tesla revealed in the quarter that will help Tesla stock get there. Please hit the like button and subscribe. We would really appreciate that. And a huge shout out to all of our patrons that help to support our channel. Your support helps us to continue to make great content. Thank you guys so much for watching.